Hello, Dan.
Hello, how's it going?
Not
Nice
too
to meet
bad,
you.
thank you. Yeah, nice to meet you. It's great to have you on ETF Atlas. And just a few words about you. You're a chartered accountant, tax advisor, and a qualified financial advisor. But what really sets you apart, at least from my point of view, is that you don't sell products. I mean, through your portal, Honest.ie, your YouTube channel, and your writing, you've become one of the most trusted voices on Irish money. And I think not only in Ireland, but I'm in Poland, and and I heard about you as well. And breaking down complex stuff in plain English is your really trademark, I would say, and helping people make smarter choices. And today, during our conversation, we'll go through your journey from auditing big funds at PwC to building an independent education platform. And I'm going also to touch on money basics, ETFs, behavior, pensions, and how you manage to stay honest and independent as an educator. So, welcome to the show.
Thank you very much for having me. Delighted to be here.
All right. So, let's start maybe with personal story and motivation why you moved from PwC. So, because you had a steady career at PwC, working with some of the probably biggest fund managers out there. So, what made you jump into making content instead? I mean, what turned out maybe even harder than you expected about trying to teach people instead of helping institutions manage other people's money?
Yeah, I mean, look, it seems like so long ago that I was with PwC, but when I was there, I absolutely loved it. I loved work. I was working in asset and wealth management, so as you said, kind of auditing the financial statements of some of the biggest investment managers in the world. Um, Ireland, as you know, is a very much a hotspot for investment funds of all different types of structures, not just ETFs, but also UCITS and alternative investment funds too. So it was really there where I kind of just got introduced to the world of investing and all the different types of fund structures and just became fascinated with how they operated. And obviously when you're working in audit, you really get up close and personal with the nitty gritty details of how it all operates in the background. But I suppose like when I was there, I just kind of couldn't help reflect on how foreign all of this felt to like I came from a business background. Like I studied business in university
Yeah.
and did a master's in accountancy. So I was kind of more than familiar with the terminology, but like just to the average person on the street, because obviously investing is something that's universally important to everyone, not just people who are involved in business. I just was just reflecting on how like if someone was to just see what I was looking at, they'd be like, what is going on here? This makes absolutely no sense. And so I just kind of felt that, with the experience, practical experience that I was getting working there, and then also with the educational qualifications, like I qualified as a tax advisor and financial advisor while I was with PwC as well. So I started to kind of build up this, I suppose, holistic big picture of how different components and aspects of finance were all integrating with each other. And I kind of wanted to just see if I could share it with more people and get people more interested and invested in their financial well-being. So during COVID, I, like many other people, kind of was looking for things to do and outlets for my time when we were just all locked up indoors. And I decided that I would just give YouTube videos a shot. I've always been interested in the kind of creative side of things. I'm a musician as well, and I've always had a real big passion for just creating things from the ground up and building them. That's why I love entrepreneurship as well. And I love video and video based content. So I was kind of thinking in my head, like, is there a way for me to kind of merge my passion for creativity and content creation with the world of finance? And as you know, like personal finance YouTube is quite big all around the world. But at the time in 2020, it was big in the UK and big in the US, but there was nobody really doing it here in Ireland. And I saw a kind of gap in the market for someone to come in and, you know, just explain concepts in a way that was kind of engaging and easy to understand. So I started off with a very simple video, just talking about the taxation of investments and explaining Irish capital gains tax and income tax and how all that works. And was very surprised at the reaction. Like it was very well received right away. All my kind of friends and family were very supportive of what I was doing, and it was starting to get organically found online. And I kind of did that for a year from like October 2020 to October 2021. And then at the end of 2021, that's when my contract was coming up to an end with PwC. So I kind of had to make a decision whether I wanted to stay on or pursue this. And I had grown the YouTube channel to a point where I felt comfortable enough that there was enough of a demand there, and I had proven it sufficiently that I kind of wanted to pursue it full time. So I left my job and I started just committing all my time to creating personal finance content on everything from investing, pensions, mortgages, insurance, macroeconomics, ECB interest rates, whatever it was. Just really trying to democratize this information and make people aware of it. And fortunately, I've been in a position now where I've done that for the last 5 years, and Honest.ie as well is my latest business venture that's kind of spun off from that, and I've gotten the opportunity to work with some amazing fintechs and neobanks and online brokers who have brought their products into Ireland, and I've helped customers get to grips with those products and done lots of cool things, traveling to different parts of Europe and speaking and doing corporate events. So it's gotten to a stage that I couldn't have anticipated when I first started, but it's definitely, especially when I see the feedback and reviews and people commenting saying that, like, a video has helped them change their perspective on investing or given them the confidence to prepare for retirement. That's what makes it really worthwhile for me. So I'm just always trying to get better every day and trying to spread the word as much as I can.
I wanted to ask you about name of your website, Honest, because you could have built a normal advisory business probably, but you went for a content first, information only model. So why was that so important to you? And what does this honesty actually look like day to day?
Yeah, I mean, look, the brand name Honest.ie was definitely very intentional, and it was meant to kind of signify what we're all about, and the purpose of the site, which is really just like transparency at its core. For the longest time when I was making the YouTube videos, I felt that they were great from an informational perspective at a point in time, but what they were lacking was just something that was more interactive that people could go onto in their own time and click around and play around with tools and calculators and guides, and really kind of just invest the time that they have to get to grips with the text on the screen. So what I wanted to kind of capture with the Honest.ie brand is that when you go there, you know that what you're reading or the tools that you're using have been created by someone who is A, qualified, but B, has no ulterior motives other than just completely sharing the facts on the different types of products that are there. Um, because like the product side of things, you're right in saying that, like, we're not a traditional advisory business. We're not like um providing one-to-one financial advice or anything like that, and selling individual products. But we are partnered with the different kind of neobanks and platforms that are featured on our platform, because the education is one side of it, but I always talk about this principle of turning education into execution. And so when you kind of independently just display the entire market and give people the tools they need to make the decisions for themselves, they can kind of take that information and go about it in whatever way they see fit.
Let's move towards some money foundations, and maybe just before touching the stock market, when someone in their, let's say, 20s or 30s comes to you with no plan, what do you tell them to do first? I mean, before even thinking about ETFs.
Yeah, like for me, so in Ireland specifically, because if we're going to talk about this, we obviously have to talk about the way things are here. And the number one starting point for investing or long-term financial planning in this country is your pension. And it is the same in many other countries around the world, but obviously the taxation rules and how pensions are treated from a tax perspective and their benefits vary from country to country. But in Ireland, the tax benefits of investing in a pension are very, very significant. So a lot of the times I'll get a young guy or girl who kind of comes to me and maybe they've seen one of my videos online, and they come and they're really, really keen. They have an email sent over to me and they're really, really keen on like ETFs and the stock market and stuff like that. But I nearly have to pull them back. And I'm saying, okay, like that's kind of like the next phase. We have to actually like look at like what you're doing from a retirement planning perspective, because ultimately, like as you are and as I am, as ETF kind of proponents and encouraging people to engage with ETFs, we are of a long term investing mentality. And a pension by definition is the number one kind of long-term product because it's meant for you in retirement. Um, so yeah, I kind of tell people to engage with their pension as much as they can. So in Ireland, you can make personal contributions to your pension through your salary, and how much you can contribute to that pension is predicated on your age. So as you get older, which is kind of counterintuitive, but as you get older, you can contribute more to your pension. We've been kind of pushing from a policy perspective to have it more level so that people at a younger age can actually contribute even more to their pension, because the effects of compounding are obviously greater when the earlier you start. So it doesn't really make too much sense to be limiting young people, like in terms of how much they can actually contribute. Yes, you obviously have to balance it with the tax revenue that the government is taking, but also if we're trying to encourage people to engage with their pension, we need to be encouraging them to get more benefits earlier on. So you kind of get an exemption from income tax on the money that you put in. Then when your money goes into the pension account and then you've allocated it out into whatever investment funds that you're kind of putting your money into, those investment funds and your investment income and investment gains grow tax free for the duration of the investment, so long as they're in the pension. And then when you actually get to retirement, you can take 25% of your pension pot tax free up to a maximum of €200,000. So there's lots of really attractive tax benefits of investing in a pension. And that's why I tell people to engage in it early and often. And then also you have all the great things like employer matching, where, if you decide to put in extra percentage points of your salary into your pension, all of a sudden you're getting free additional money from your employer because they'll match you on what you're putting in, which can be great too. So yeah, for me, it's just like pension, pension, pension. And that's very aligned with what our government are going to be trying to do over the next 20 years, because we have a really, really serious retirement crisis in this country, because our population is aging very, very quickly. And by 2050, there's going to be double the amount of people in retirement as there is now. And the ratio of people drawing on our state pension relative to people in the workforce who are paying for that state pension is going to be lower. So there's going to be a really significant stress put on our resources. So it's becoming so important for people to have adequate private pensions to support them in retirement.
Okay, we'll go into some more details in a minute. But before that, Dan, you've said many times that people hate budgeting. Do you have maybe some simple, let's say, no spreadsheet way to stay on top of money? And how do you explain the difference between maybe good debt against the bad debt?
Yeah. It's funny because I was having a conversation with one of our national newspapers there in recent weeks, and we were kind of talking about the three or four things that I kind of tell people to get a general financial plan in place, which is really, pump the pension, long-term investing in ETFs, high yield savings accounts, and then the big one, as you just mentioned there, which is avoiding expensive short-term debt. I think it's becoming easier than ever before to access personal short-term debt, especially with buy now, pay later, and the way that a lot of the neobanks and digital banks are integrating these services into their core banking products as well. And when you're checking out online, buying something on online shopping, that button is always there just to kind of buy now, pay later. And then also, it's very, very easy to get personal loans on digital apps now as well. And obviously they attract very high interest rates, 15, 16, 17% in some cases. And really, from a budgeting perspective, you have to realize that the interest that you're paying on that loan is effectively eating into your ability to either contribute money to your pension or to invest in long-term assets. So, it's sometimes easier said than done, but obviously everyone is obviously advocating to stay away from personal debt if possible. It's not always possible. People find themselves in situations where it becomes a necessity, and you absolutely have to empathize and sympathize with that. But in saying that, the important thing is recognizing that short-term debt is ultimately not beneficial in any way towards your long-term financial independence. And if you are in a position where you've taken it on, you kind of need to clear it down as soon as possible. But in terms of from a budgeting perspective and how you view cash holistically, famously, I don't like rule of thumbs. I think rule of thumbs are good as a reference point, but I think they put a far too simplistic view on the world, and they don't take into account the complexities of individuals people's lives. Like it's very easy to say, oh, 50 30 20 budgeting, or have 3 to 6 months worth of expenses in an emergency fund. Like anyone can kind of say that as a guideline, but ultimately all of us as individuals are so incredibly different, in terms of our life circumstances, in terms of our financial resources, their occupations, our health, whether we have kids, where we live, our short-term goals. So it's really hard to just say, you know, hey, people of Ireland, if you're having an emergency fund, that has to be 3 to 6 months worth of expenses, and then that's kind of it. It's like, no, it's really like for you as an individual, for an emergency fund, let's say, how much do you need to have in your bank account at all times to get a good sleep at night? And like really asking yourself that intrinsically and reflecting on that fact, while also being aware of things of like, okay, I know from Dan's content or for other sources online that having excessive amounts of cash sitting on deposit is ultimately not good because of low interest rates and negative real returns after taxes and inflation. But in saying that, if I do have to have some cash, how much cash is that going to be for me to be comfortable? So it's an intrinsically personal decision, and I think that's why the more comprehensive information only needs of the many versus needs of the few approach with the website is quite good, because we equip people with the information and then they can go and take that and reflect on it relative to their own personal circumstances and apply it as they see fit.
In Ireland, and I think really across Europe and probably even world, people put nearly all their wealth into the homes, real estate. How do you talk about that trade-off between, from one side, paying off the mortgage and investing for the long term?
Yeah. Like it's honestly, it's kind of crazy. Like Irish people just obsess over home ownership. It's just something that's absolutely embedded in us as a people and as a culture. And to the desire to own your own land, to own your own property, it's really something that we're taught from a young age that like this needs to be a life goal of yours. And like again, part of what I do is like I say, yeah, it's good, but it might not be for everyone. Like I try to take an independent view when I'm talking about like home ownership and pros and cons of buying versus renting and all those kind of discussions. And just like, because I feel like there's a lot of societal pressure in Ireland when it comes to buying a home. It's like you grow up and you look at your friends around you and everyone's kind of getting married and having kids and putting a deposit down in the home. It's like, oh God, that's what I have to do, right? That's how that will define whether or not I'm ahead in life and stuff. So I kind of like keep the road open, say, hey, home ownership might not be for you. Like look at places like Germany where home ownership rates are, nowhere near as high as they are in Ireland, and people are a lot more comfortable renting. Um, but in terms of that trade-off between paying off the mortgage and investing, I mean, there's two sides of it. Like a mortgage is the cheapest debt you're ever gonna obtain. And depending on things like, in Ireland you can get things like green mortgages, where if you're buying energy efficient homes, your mortgage interest rate can get even lower. If your loan to value ratio is really good, that rate can get even lower. So all of a sudden you have this really great access to long term inexpensive debt relative to inflation as well. And so like, the maths kind of shows you that really paying off your mortgage is good from like a psychological perspective, and it might make people feel better about like their overall debt levels. But in terms of like the monetary value that you would get from paying off your whatever it is 3% mortgage versus you know the 8 to 10% average returns of the global stock market on an annualized basis, it's not really comparable. So like it's, if you do have the capacity to be investing either again via the pension or via ETFs, after you've kind of paid down your direct debit for your mortgage, I see no reason why those funds shouldn't be being directed into long term appreciating assets. It just seems a better use of cash to me.
So let's move to investing then. And once, let's say, someone has the emergency fund and no expensive debt, what does your, let's say, default long term portfolio look like?
When I first started getting into the world of investing, I, like many people, was kind of just drawn to this idea that like, stocks are cool, and like, picking individual securities is like the way forward, and it feels more legit and more like how Hollywood portrays investing to be. But I very kind of, and that was me coming from a place of, having the practical and educational experience in business and finance too. But I kind of quickly, came to the realization that the long term portfolio is something that is going to be more beneficial to my own financial well being long term, and definitely to that of my viewers as well. And that's why the whole channel, if you go back and look at my videos, like I never really made any sort of videos talking about like individual stocks and whether or not I think their price will increase or decrease, because in reality, who actually knows? And you're much like, if you even look at like the Spiva scorecard data, it just consistently shows that passively managed long-term funds just consistently outperform their active counterparts. So yeah, the long term portfolio for me, I mean, I really kind of talk about it in two avenues. I think the most simplistic approach is obviously just, the all world global ETF accumulating product that you can buy at kind of the lowest total expense ratio that you can find, and just consistently invest in that on an ongoing basis. But if you do want to have more flexibility over the geographies and the assets that your contributions are actually being invested in, you can obviously go for the more piecemeal approach where you kind of emulate that global ETF by buying, maybe an S&P 500 ETF, a Europe ETF, and an emerging markets ETF, and then allocating your resources across those three geographies as you see fit. Maybe you're feeling that you want more exposure to a European aspect, so you just would change your contributions on a monthly basis to be more favored towards that versus S&P and emerging markets, where obviously if you have one single global ETF, you're restricted to the weightings within that individual portfolio. So I think it really just depends what people want to do. And like it's hard to know, because like, a lot of the, Ben Felix obviously talks about this a lot, with like, realistically, the most simplistic and statistically proven way is to just pick the global ETF and just do that and don't think twice and come back in 30 or 40 years. And I suppose if we do break it up more into the counterparts of different geographies, we are kind of taking a bit more of an active approach, and we're trying to use our gut feeling to guide our returns, which may or may not prove to be beneficial. So yeah, like from an ETF and long term perspective, it's just like pick the strategy that works for you, and commit to investing as much as you can, as often as you can, and try to avoid lifestyle creep, and ensure that when you do get those increases in salary, that you're allocating them towards greater contributions to your investments as much as you can.
All right. In your video, How to Invest 100 Euros, you break it into 3 steps. Could you please quickly walk us through them?
Yeah, it's funny about that one, because like again, these kind of videos were kind of common in other markets, but there was never really applicable to actually like the Irish market, of like how to actually, day one, I have €100 to invest. What do I actually do? And like people just, you can't, it's very, very tempting to just jump straight to like the investment stage. And like people are like, oh wait, hold on. How do I even go about getting there to begin with? So yeah, we were kind of just talking about like the 3 steps of actually investing €100. And step one was always just like pick a broker. And when you're picking a brokerage in Ireland, you have a lot of choices. The major ones that are operating here at the moment are Trading 212, Trade Republic, Lightyear, DeGiro. So we definitely do have, a decent selection in terms of brokers that are actually here, and which one you choose kind of depends on, I suppose, how you plan on using the app yourself as an investor. But when considering that I primarily talk about ETF investing on the channel, I'm nearly always talking about, okay, well, which brokerage platform is going to be best suited for ETF investing activities? And a lot of the time that comes down to which broker charges the least amount of fees for ETF investing, and which broker has the most competitive selection of ETFs. Because it's gotten better now, but definitely a couple of years ago, there was quite the disparity in terms of like which ETFs were available on which investment platforms, and they're starting to become more comparable in terms of like the offerings, but there's definitely you'll still find occasionally you'll find an ETF that is available on, trading 212, or might not be available on DeGiro, or vice versa. So you kind of have to um, nearly work backwards sometimes when you're actually going and picking your ETFs, and then making sure that that ETF is actually available on the investing platform that you want to use. Um, but yeah, like from my experience, Trading 212 and Trade Republic have really, really competitive investment selections in terms of like the best ETFs, and like, how we kind of classify them with respect to like picking the ETFs that offer the exposure that you're looking for at the lowest total expense ratio. So step one is really just kind of figuring out which brokerage is gonna fit best with you. But as I said, they're all kind of user intuitive. Trading 212 definitely has, I would say, on the whole, the most competitive offering from a technological um, and fees perspective, and it's quite a nice platform. But there's tons of benefits to the rest of the platforms too. So kind of once you've kind of got to grips with, what brokerage platform you are using, and you understand the features and safety too, because like it's not just about the investing with these platforms. There's also things like, the interest rates that you earn on uninvested cash, which can vary depending on the app. Like, with Trading 212, I think you get like 2.2% at the moment on your uninvested euros through their money market funds. But then also understanding that that's not a deposit product and covered by the investor compensation scheme and not the deposit guarantee scheme, versus something like Trade Republic, where you're getting 2% on your uninvested cash, but that's actually in a deposit structure. So it's covered up to 100 grand under the deposit guarantee scheme. So like understanding those nuances and picking the one that's best for you, and understanding the kind of the EU regulations and safeties that apply to each brokerage is quite important. Then you kind of move on to that second phase, which is actually like picking the investments. And that's where, I suppose websites such as yours are so useful, because you're trying to, there's just so many ETFs like nowadays. Like it's overwhelming. There's an ETF for absolutely everything. And as a beginner, you're logging onto a brokerage platform and you're seeing all these like, what the hell is an ISIN and what are all these codes? And like, it can be quite overwhelming, and lots of data and TERs and, bid ask spreads and like what's going on. So you're kind of like trying to find like, what is the metric for deciding which, ETF is going to be good for me. And, specifically when you're looking at things like, an S&P 500 ETF, a lot of the times I would find on average 90% of Irish investors just want to stick with an accumulating ETF. They actually don't want dividends to be paid out, just because the taxation of ETF investment income and gains in Ireland is very punitive. It's not good. It's not in a good place at the moment. So people try to avoid having those distributions be paid out and just keep it accumulating as much as they can. So really, it becomes a question of like, okay, which ETFs provide me with exposure to the portfolios that I want, or the assets that I want exposure to at the lowest cost, right? So like, which ones are going to have the lowest total expense ratio, which is inevitably going to improve my investment returns over time if I can minimize that, in addition to minimizing my charges with my brokerage. So that's step two, is just doing the research and really trying to find what those investments are. And then step three is just pulling the trigger, like, and really, I think if your brokerage platform has automated investment technology whereby you can schedule recurring monthly investments into your ETF or ETFs of choice, I think you should definitely do that, because I think the more we can remove ourselves from the investment decision and the holding decision, the better, because our psychology just gets in the way. That's what Benjamin Graham always said, like the investor's chief problem and even their worst enemy is themselves. So it's kind of like, this technology exists for a reason. So once you have made the decision, you picked your brokerage, you picked your ETFs, use the technology and just put your investments on autopilot. And when you are coming back to revisit it and look at it, I would say it should really only just be to increase your contributions if you can, if you have the ability to do so.
Great, thank you. Dan, we've talked about some general advice, but how do you invest yourself then? I mean, what does your personal portfolio look like? And has it changed maybe over the years based on what you have learned on the way?
As I kind of said there, like when I first started investing, which was back in 2017, I thought I could, outperform the market by picking individual stocks and using my experience to analyze financial statements. Like I used to actually like spend time downloading annual reports and financial statements and creating my own cash flow projections, and obviously looking at what other people were doing, looking at analyst recommendations and all that kind of stuff. And I quickly just realized that A, I just do not want to spend my weekends doing this. And B, all the data over the last 100 years shows that I'm not going to be successful doing it anyway. So I was kind of like, right, how do I just put this on autopilot and set and forget and just stick to the basics and the principles and trying to get more people involved in this. And the easiest way for me to do that was to just a start a pension, which I did in early or late 2017. Kind of just getting in touch with my payroll department at the old firm and kind of saying that I wanted to maximize my personal contributions. And then when I ended up maximizing those contributions, I did the thing that very few Irish people actually do, is I actually logged into my pension platform, which very few people actually know they even have a pension platform in this country, and that's how bad the awareness is. And I went in and I started choosing the investment funds that I wanted those contributions to be allocated towards. And I think I went like 100% just into like a North American um, indexed fund, and just kind of held that in the pension and had that recurring. And then for my personal investments, I still hung on to all the like I still hold all the original stock investments that I made. I don't think I think I've sold like only a handful of less than a handful of times in the last like 6 years. I very much just buy and hold, and kind of just commit to the decisions that I've made. But the it was interesting because during obviously during COVID, it was such a volatile time in the stock market, and prices were absolutely hemorrhaging. So it was a great time for value investing because you could get a lot of great deals. And there's probably no better example than that than Irish bank stocks. Um, Irish bank stocks during COVID absolutely hemorrhaged value in terms of like their market cap, and they went to really, really, really severe lows. And if you actually look at the statistical data for the Irish banking sector relative to the US banking sector and banking sectors in other economies, the recovery rate between COVID and let's say 2023 in Ireland for bank stocks was the highest in the world. So you would have made the highest amount of returns. So I was definitely very, very interested in Irish bank stocks around that time. But again, I knew that all that kind of active picking of stocks wasn't sustainable for me, just because I just didn't have the time to commit to trying to do this successfully. And I always reflected on like the Spiva scorecard kind of data, where it's like, if the active investment managers with literally unlimited resources and the best investment technology in the world still can't, consistently beat the index, what kind of chance do I have? So I quickly kind of migrated my investment strategy over to a handful of just ETFs, index funds. So I think at the moment I have, like I said, one S&P 500 ETF, one developed Europe ETF, and one emerging markets ETF. And I kind of just have an asset allocation and a contribution schedule that kind of just goes out to each of them, and I'll change it over time if I feel like I need to. But like that's how simplistic I like to keep it. Is just I find the the two or three best funds that I want to invest in, and every now and then, I'll go on to ETF Atlas or whatever, and I'll find like, okay, who's the latest fund that has launched here in Ireland who is offering a really competitive TER, and then if it's a really good offering, I won't sell my previous holdings, but I might then stop my contributions to my previous ETFs, and then um I might like pick them back up again and start reinvesting into the new ETF that's offering better value. So there is a bit of like maintenance and just checking that there's no new best ETF to invest in, but for the most part, it's just keep it super simple with two or three ETFs. Yeah.
Right. Great. Thank you for that. By the way, regarding active versus passive, I had recently here on the show Larry Swedrow, and he mentioned that in the recent decades, actually, active investing is harder because it's more professional. So basically, like in United States, around 2% of active managers are able long-term to beat the benchmark. So it's really very difficult. I wanted to ask you about something called, I'm just calling it the Irish ETF paradox, because like even on ETF Atlas, we have over 12,000 ETFs, but it's because we have also United States and US and Canadian ETFs. But just in Europe, we have over 5,000 ETFs, and almost 70% of these ETFs are domiciled in Ireland. But actually, Ireland, I would say, is like ETF hub of Europe. Yet most Irish households don't invest. So it sounds like, like a paradox. Why do you think that is?
You're really speaking my language now. Like this is this is the eternal problem, and it's probably one of the greatest I don't know, not hypocrisies, but the greatest tragedies at the moment is that like, Ireland is, as you say, is the it's a global leader, but it's certainly a European leader in ETFs, and we're one of the most popular domicile locations of choice for ETFs to come here, and a lot of that has to do with our taxation and our vast array of tax treaties that we have, specifically with the United States, making us a really attractive option for setting up US based kind of equity funds and S&P 500 funds. But yeah, it's funny that we have that, and we have so much economic activity in ETFs and the investment fund space here in Ireland, but yet we have a people and a population that is absolutely totally estranged from ETF investing, to the point where if you came to Dublin and you walked down our main street in city centre and you asked, as many people as you could to tell you what an ETF is, they would look at you being like, "Oh, sorry, do you mean electronic funds transfer? Do you mean EFT?" Right? That's what you're talking about, right? And it's like, oh god, yeah, it's a challenge, and it's just there's a number of reasons why it is, right? So it's like we to begin with, right? I don't want to blame schools or like the education system as a whole, but like we're not taught about this stuff from a young age, right? It just doesn't happen. I know nowadays there's some programs in Irish secondary schools, which is our schools for like from ages 12 to 18, where they bring in these people to like try to teach you about finance initiatives, but like it's not really taught on a serious level. And yes, you can do business and economics and accounting in school, and but you just learn the classic academic side of those topics. You don't actually understand or learn about the rules and like everything as it applies to Ireland. Um, and like that's what I found most startling. Like when I did the QFA, the Qualified Financial Advisory exams here in Ireland, when I was studying this, I was like, we need to have a version of these exams for secondary school students, because like those exams, wouldn't necessarily be considered as complex or difficult as something like the tax qualification or the accountancy qualification. But in terms of real world, actual practical value, they just are so comprehensive in covering all the different aspects of investing in pensions and mortgages and all that kind of stuff. So, having something like that at a younger age would just help people be aware of it. But that's only part of the problem. Other problems include the two institutions that are responsible for financially educating the people of our country are the Central Bank of Ireland and the CCPC, which is like our Consumer and Protection Commission. And both of those institutions are utterly failing at their jobs, right? And I'm not trying to throw shade at the people who are undoubtedly putting in a lot of hard work trying to get this information out to people. But I think there is an inherent disconnection between the people who are responsible for educating the people of a country about financial topics and the ways in which people actually want to consume that information. And there's no better example than that than, let's say, my YouTube channel, because I've probably reached many, many multiples more people and added more tangible, real world, practical financial value to the lives of real Irish people from my bedroom with a €50 webcam and a little key light than the people who are literally responsible and tasked by government to create educational programs to reach these people have. And I don't say that like with any sort of pride. It's just that to me reflects the disconnection between, you know, no one's going to read your PDF that you put together on like, these are the different types of asset classes. Like, that's not how people want to consume information. You need to break these inherently boring and complex topics down into a way that regular people understand and want to engage with. Otherwise, you're just going to lose them. Um, and so, like, I just think that's a big part of the problem. The other thing is Ireland is, we as a people are very distrusting. We're very conservative. We have a lot of financial trauma in this country from the financial crisis. And a lot of that is intergenerational in the sense that it's passed down. Bad money habits are being passed down from generation to generation. The Celtic Tiger, which was like our boom period in Ireland in the late 90s and early 2000s, was a time when, everyone was getting, you could walk down to the bank and get a mortgage, 100% mortgage, no problem. While you're at it, here's a loan for your second home or your car or whatever. And people had like unlimited money, and they had all this faith in economists and bankers who said that it could never go wrong. And then ultimately, when the financial crisis happened in 2007, 2008, people lost everything. And we still haven't recovered as a people from that. And I think anytime the topic of finance is brought up, people always think, what's the catch? How are you going to scam me? How am I going to lose money here? And when you have that sentiment and that mentality in a people and in a culture, they're inherently less willing to try new things. And that's why, we have 144 billion euro sitting in low interest deposit accounts earning 0.13% on average, 170 billion euro sitting with the banks just doing nothing overall. And like, that's just an absolute crisis from a wealth management perspective, because that money could be, as I said, going towards pensions or going towards ETFs. And it's not only beneficial for the people, it's beneficial for our country and the government as well, because the government is going to get a lot more tax take from capital gains tax on investments, or exit tax on funds tax on ETF investment gains and income, than they are from a 33% deposit interest retention tax rate on 0.13% worth of interest on a bank deposit. So there's just a whole host of reasons as to why people aren't engaging. But I think a big part of it is education. A big part of it is conservatism, fear, uncertainty, doubt, lack of understanding, and just not enough educational resources out there. So that's what I've been trying to change for the last 5 years, and what we're trying to do with the website. And fortunately, we are seeing some sort of change in government. We recently got a very minor, but we'll take it, positive change to the taxation of ETFs in Ireland. It's still an absolute nightmare from a taxation perspective, but it's gotten a little bit better. And there's talks now of having, number one, making those taxation rules a lot better, but also number two, introducing a tax efficient savings and investment scheme, which will hopefully increase the uptake of investing in this country. But yes, you are right. Our attitude towards ETFs as a people does not match where we are globally as an ETF leader.
Yeah, even on our portal, as I said, most of the ETFs in Europe are domiciled in Ireland. So it was very interesting what you just said. So it sounds like you still have a lot of work to do. So good luck with your mission. I wanted to ask about the currency hedging, especially regarding the equities part. Namely, does currency hedging ever really make sense for long-term investors? And I mean here, especially ETFs, which are currency hedged.
Yeah, I think there's arguments for and against. So when I first started investing, I used to buy euro hedged ETF versions of specifically the S&P 500, because my kind of thought process was I wanted to get the pure returns of the underlying investments, and I didn't want the FX movements between the euro and the dollar to eat into those investments. I actually remember when I was in PwC. Um, Before I had started investing, one of my friends had gotten to investing like a couple of weeks or a couple of months before. And he was talking about how he was really frustrated because, he had made an unrealized gain on an investment, but then had checked the currency movement between euro and USD and quickly found that gain had just been completely eradicated by the movement in currency valuation. And that kind of highlighted the value of hedging to me. And I think, you know, it works both ways. It's similar to like euro cost averaging or dollar cost averaging. It's like it can go one of two ways. Like it's really good if you euro cost average and the market keeps going down because you've made a good decision then versus lump sum investing at a point in time. Whereas if you euro cost average but the market just keeps going up, you would have been better off just lump summing from day one. Similar to the hedging argument, where it's like, yeah, hedging is fine if it goes your way, but if it goes the opposite way, you're also not getting the positive impacts of good currency movements in your favor too. And again, that's also something I saw Ben Felix talking about somewhat recently, where he was saying that ultimately currencies are just another form or an expanded form of investment and diversification on top of the investment itself. The question is whether or not you want that extra layer of diversification in your investments. And some people are just more comfortable having everything in euros and not being hyper concerned with the impact of foreign currency translation on their returns. But I think as a long term play, I think if hedging was some sort of godly proven strategy, I think everyone will be doing it. And I think the fact that it's kind of like, oh yeah, take it or leave it, is kind of evidence in and of itself that probably either way, you're probably better off just doing it without it. But again, if it is something that you're concerned about. And also the other side of it is you pay a higher TER for that, right? So
Yeah.
they,
Yeah.
hedging isn't free. Um, they have to use like forward currency contracts, or the fund manager has to use them to actually provide that hedging for you. So, you're paying a higher TER price, which is obviously going to impact your investment returns. And then whether or not you actually yield benefit from that will obviously depend on the currency movements, which ultimately you cannot control. So you might end up even worse off anyway because you paid a higher price and the currency moved in the wrong direction for you as well. So it's just one of those things that comes down to personal
Sure.
preference. And if you want to keep it simple, just do without it.
Yeah, sounds great. I wanted to ask you about the new wave of ETFs, because ETF nowadays are not really a synonym for passive investing anymore. I mean, they are really a wrapper for anything. And we have a lot of active ETFs, factor funds, covered call ETFs, and so on. Are these real improvements, or just maybe they making more noise for investors?
Yeah, I think they're distractions, really. I think there was a time where kind of ETFs were just synonymous with index funds and passively managed investments, and that's what it was. And like if you look at like, John C. Bogle, founder of Vanguard, like that's really the mantra that he subscribed to, was just the long term global diversified approach. And I feel like nowadays, with there being an ETF for literally everything, we've kind of slipped away from um maybe what their core purpose was intended for, which was simplicity kind of above all else. I think like even during, 2020, 2021, when you have like, ARK Invest and Kathy Wood's selection of active investment funds were certainly very popular, like the ARK Innovation Fund and things like that. And I remember people asking me about that and saying like, oh, like this is probably like a better alternative or long term option than like the S&P or whatever. And it's just like it's not it's it is an ETF. It's structured as an ETF, but like the what you're calling diversification is not diversified at all. You know, yes, it's diversified across a wide number of companies who barely have revenue and have absolutely insane multiples. But just because you have loads of them, that doesn't make the investment itself safe. So yeah, I think I get these questions all the time where people email me and they're like, "Oh, I'm looking at this new ETF in this sector or this sector or this kind of asset class." And I think it's great that people are taking an interest in it and are trying to explore alternatives, but equally just go back to what the historical data has shown us is that there are a very clear select number of winners over many, many years. And I think for the vast, vast majority of people, like the 99%, who's the people that I'm trying to resonate with, the best thing you can kind of do for yourself is keep it simple and like exploring with things like derivatives and cover calls and all that kind of stuff is it's great if you're taking an interest in that and you're willing to do it, and you're, again, I would say probably not as like the core of your investment strategy, more kind of towards the fun money kind of side of things. But some people are just like hell bent on doing that, and that's what they want to do. But I think for the average person, it's just like block out the noise and just stick with the products that we know work.
Right. I wanted to touch behavior and stay in the course. Actually, you mentioned about emails you get from your YouTubers. From all the comments and emails you get, what are the most common traps you see? Maybe I mean, like maybe FOMO, panic selling, and how do you help people avoid those habits?
Yeah, one of the most common ones I get is definitely people questioning the viability or the true performance of ETFs, specifically in the Irish context, because again, just going back to that taxation piece, the taxation of ETFs in Ireland is, and again, it kind of goes back to this hypocrisy we were talking about how Ireland is a global leader for ETFs, but yet our people aren't. I think there's no better example than that than our taxation policies. So ETF investment gains and income are taxed at a rate of 38% at the moment in Ireland. And the most, I suppose, damaging tax policy at the moment is called deemed disposal, whereby every 8 years, your unrealized gains on your ETF investments are taxed, irrespective of whether or not you've sold. So we actually have a tax policy that goes against all traditional rational tax policies and actually taxes unrealized gains. And we're actually, I think I saw something recently that the Netherlands are considering introducing something similar too. But it's absolutely insane. Like it's counterproductive to people long-term investing, and it goes against the principles of what the investment is for. Now, I understand it. I understand why it was introduced, 25 years ago, 26 years ago at this point, which was the Irish government were really concerned that an investor would come along and put money into an accumulating ETF. And because we don't tax ETFs at the ETF level, the government would never see tax until the investor actually sold, and they could defer sale for 30 or 40 years and they would never see a penny of that. But the point is that they're investing after tax money to begin with. So that's why we want it to be more aligned and to be more positive for helping people engage with these products. But I get emails from people saying that, oh, well, like, I'm taxed every 8 years, irrespective of whether or not I sell. Surely me picking individual stocks is a better way to go, right? Because when I invest in individual stocks, my unrealized gains aren't taxed until I sell. And when they are taxed, they're taxed at a rate of 33% versus 38. It used to be 41. And the flaw in that thinking is that they're assuming that they can achieve the investment performance that an ETF would achieve with their own personal investments. So they're assuming that they can achieve a similar amount of unrealized gains long term via individual stock picking, and that in turn will allow them to improve their financial position because those unrealized gains won't be taxed every 8 years, and then when they do sell, it'll be taxed 33. That goes against the whole point. The whole point is that the data says you can't, right? You simply won't be able to consistently pick winning stocks that over, you know, 10, 15, 20 years outperform the market. And so the differential in that tax treatment very rarely works out in your favor for choosing individual stocks over ETFs, even with the really punitive tax policies that we have now. And that's what we kind of like to call distortionary tax behavior in the world of tax, where your tax policies are actually influencing the ways in which consumers are making decisions about their investments. And it's not a good thing, right? So good tax policy shouldn't be distortionary. If I want to invest in ETFs and I feel like it's an appropriate product for me, I should be able to make that economic decision without saying, oh, actually the tax policy is so bad that now I'm forced into stocks and that's not a suitable product. So that's distortionary behavior. So I have to like talk these people off the ledge of like, jumping into stock investing because I know the path that they're going to go down and I know it's not going to, I can't say for certainty, but I'm very confident that it's not going to work out the way that they think it will. And I try to have to kind of get them to stay the path and, you know, because it is every 8 years, the tax horizons, I have to kind of be like, look, by the time this comes around, the government will hopefully have eliminated the tax policy and all will be well. And we're definitely making steps towards doing that. There was a huge like social campaign over the last couple of years where people in industry and regular retail investors submitted applications to a review process carried out by the government, and we're all screaming out saying that we want this changed and we want this to be aligned with capital gains tax. So hopefully it is coming. So that's one of the more common ones that I get. But like you said, I always get ones all the time about like, when's the best time to invest? Should I wait until there's a market dip? Should I be going in and out of the market constantly? And it's just like, I think like at that point, I'm like, okay, so you haven't come to terms yet with the fundamentals of like what long-term investing is really about. Is that like you're never going to be able to time your entry nor exit to the market effectively? All of the research that shows, if you miss whatever the 10 best days of being in the stock market because you're trying to time the market, your returns get reduced by an unfathomable amount. So, like if this is something that you want to do and you have really subscribed to the mentality of long-term investing, then you should have absolutely no problem just starting today. And even if the market does go down tomorrow, that shouldn't bother you because you know that in the context of a 10 or 15-year stock chart, you're not even going to be able to see that little blip that you're so concerned about today. So those are some of the more common questions I get.
All right. So just to summarize then what we've talked about investing, if you build a simple automated money system for a friend that they could actually stick with for, let's say, 20, 30 years, what would it look like?
Automation number one is kind of a personal automation, but I would automate myself to commit to fully utilizing my allowable personal contribution limit for pensions in Ireland. That would be automation one, and that would come out automatically from my salary because I would tell payroll that I want to contribute the full max amount. That in turn would go into my pension portal, which I've set up to automate those pension contributions into global index funds. Now, it could be a single global index fund, or as we said, we can split it in whatever way we see fit between North America, Europe, and emerging markets. So that's kind of the pensions automation I would do. I definitely wouldn't neglect the emergency fund. I know we haven't talked about it a lot here, but people do have to have cash to survive. That's just a fact. I wish we lived in a world where we didn't have to hold cash, but I would definitely have some sort of emergency fund built up that you determine based on your own intrinsic feeling about how much you need to have to sleep comfortably at night. And if we do need to have cash set aside for short to medium term goals, like maybe you're saving to go on holiday in the next 6 months, or maybe you're looking to save for a deposit on a home, or you're saving for a wedding or a home renovation, then if we do have to have that cash, when it hits our bank account, we're hopefully using a current account that isn't a traditional old bank that doesn't have digital savvy products, and we can use automation to send that salary into buckets where they hit high yield savings account options, where we're trying to at least protect our money from the effects of inflation and taxes. So we're not saying that we're by any means going to get wealthy or financially independent by holding cash, but that should be the goal. At least 2% in Europe, ideally 3% if we can get it. Then, from an investment perspective, if we've maximized our personal contributions to pensions, we've satisfied ourselves that we have our emergency fund. We've satisfied ourselves that we're meeting our savings goals for our short to medium term objectives, and we've obviously covered all the important things like utilities, bills, mortgages, childcare, whatever it is. If we're at a position where we still have excessive amounts sitting idle in our bank accounts that we want to put towards long-term investment practices, that's when we look to long-term investing via ETFs. Again, how do we do that? We go back to the 3 steps. You decide on your brokerage platform. You ideally pick a brokerage that is low cost, which charges little to no fees for investing in ETFs consistently. One that ideally has a fantastic selection of ETFs, and one that supports automated investing into ETFs on a consistent basis. Why? To remove the human emotion decision from that, so that no matter what, we are sticking to our consistent investments in ETFs, no matter what way the market is going, and we're not opening up our phone and checking every 2 seconds if we've made gains or losses. And we just commit to whatever ETFs we choose, which again, we talked about the simplistic single all world global ETF versus the more segmented approach where you have the 2 or 3 ETFs focused on different markets, and you allocate your contributions across those ETFs on an ongoing basis. You occasionally check to see if there is a more competitive ETF on the market with a lower TER. Maybe you consider things like currency hedging if that's important to you, but you also recognize that that's going to come with a higher TER, and it might not necessarily yield positive results overall. And then finally, I would just say, as we kind of progress in our careers and we meet some of the goals and objectives that we wanted, like we've bought a house, or we've paid off our mortgage, or our kids have gone to college, or whatever it is, and all of a sudden we have access to more cash and we've more of our income hitting our bank account. You always have to revisit the contribution levels that you've set. So you, at a point in time now, deciding how much you can invest is all well and good, but you need to revisit that, because ultimately what you want to do is you want to increase the size of your investments and the money that you're actually putting in over time. It's fine just setting it up now today, but ideally the more money that's hitting your account, the more you're going to benefit from the effects of compound interest, and the more your wealth is going to grow. And also, we much prefer having excess discretionary income hitting investments rather than buying a fancy new car or things that are just not going to add a whole lot of value to your life. So that's how I would kind of see the holistic kind of big picture being somewhat automated in my brain.
Sounds great. Thank you for that, Dan. We are reaching to the end, but before we will finish, I wanted to ask you more about your site, Honest.ie. At some point, videos and articles probably weren't enough, because I see that you are developing comparison tools on Honest.ie. So I wanted to ask you, what gap were you trying to fill? Because I see also some other tools are on the way, coming soon.
Yeah, I think that, again, the biggest gap is what I was talking about earlier about, education is fine, but execution really matters. And I just wanted to have a place where people could go and actually put what they were learning into practice in an environment that was very safe and transparent and holistic. And, I love making pages and products that are very like leave no stone unturned. Like if you walk away from a page that we've developed or a video that I've made with a question, I haven't done my job, right? So I have to nearly anticipate the questions that people will have in advance and try to create the best product I can that will answer all those questions and make it super simplistic. So, we've just launched our savings account comparison tool. And the whole idea is to educate people on the fact that you can actually save money with banks that aren't the 3 major Irish retail banks, which people don't know about, because the Irish banks are obviously not incentivized to tell people who their competitors are. And going back to that conversation we had earlier on about Irish people being very distrusting of anything that they're not familiar with, the idea of putting money with a non-Irish European alternative is somewhat fresh in our minds. So that's what our comparison tool is there to do. It shows you the different kind of AERs that you can get on different account types, be it, you know, an instant access account or fixed term accounts of different durations. But that's really kind of only step one on the site. We kind of have our next section that's coming is going to be banking, where we kind of really delve into the current accounts that people are using for day-to-day banking and really highlighting the benefits. Automation is one that we just talked about, of modern digital banks, where you can literally, as soon as you get paid, all of your money is just funneled off into the places that it needs to go. And while that might not feel like a very initial cost saving, value adding feature, it really is, because it removes the human decision from it and frees up our time to do more value adding activities. And then after that, the section that I'm probably most excited about and probably most relevant to this discussion we're having is our investment section. And that's going to really, ETFs are going to be a huge part of that. So really trying to create the best guides and tools for coming to grips with ETFs in Ireland. And like, again, like that video I made, how to invest €100 as an Irish investor, like you should be able to come to the site knowing absolutely nothing, and walk away knowing very comfortably, yeah, this is what I need to do to get started with my first €100. And I also feel comfortable knowing that everything has been covered, and it's kind of up to me now to put it into practice. So we've beyond the tools then as well, like we will have comparison tools where like we compare brokers and we compare different ETFs and the TERs and some of the leaderboards for the best ones. We'll have calculators and stuff so people can visualize their investment returns over time. But also what's really important is like our objection handling articles. So like the Irish taxation system is very much a handheld system. We're not used to having to file tax returns in Ireland. It's just not something the average person does. It's all automated and done for us. But for example, with European savings accounts, when you earn deposit interest through a non-Irish bank, you have to declare that interest as part of your tax return at the end of the year and pay tax on it. That is just completely foreign to 99% of our people. So we have like a very comprehensive guide step by step on how to do that. And the whole point of that is to anticipate people saying, I don't really want to try this out because I don't want to have to do the tax return. So you have the guide there to help them and to handle that objection. Likewise, same with the deposit guarantee scheme. Are these banks really safe? Like, what happens if it goes out of business? And then educating people about the European deposit guarantee scheme. So we'll do the same thing with investments. We'll talk about, you know, how brokers use asset segregation to keep assets safe in different, you know, SPVs and things like that, and the investor compensation scheme and the benefits of holding investments across multiple brokers. We'll talk about fees and all that kind of great stuff. So we have a lot of work to do, and we're trying to really cover every topic holistically, but very confident that once we have this site in the place that we need to get it to, it will be a great it will be a great service and value to the Irish people. And I hope that we can help people get more engaged and interested in personal finance and investing.
Sounds great. Dan, thanks so much for the conversation and for the work you're doing to make investing education clear, honest, and practical. I will link your website, your YouTube channel, and your guides in the show notes so listeners can explore more. So thank you so much.
Thank you very much. Cheers.
All the best. Cheers.